Welcome to Thrupenny, the smarter DeFi ecosystem to lend, borrow, and invest in crypto assets. In this video, we will introduce to you the concept of DeFi lending and borrowing and its main applications and benefits. The concept of lending and borrowing has been around for ages and is one of the core aspects of any financial system. Traditionally, lending and borrowing are facilitated by financial institutions such as banks. Depositors deposit their money with the banks, and these funds are used to lend to borrowers in the form of property loans, car loans, business loans, etc. Depositors earn interests on their deposited funds, while borrowers pay back the principal with interest when the loan is repaid. The downside to this traditional form of lending and borrowing is that banks take a huge cut of the interests earned as opposed to depositors who get only a very small cut. Depositors relinquish their assets to the banks without full custody of their money and have no control what their money is being used for. The borrowing process can be very cumbersome because banks perform KYC checks leading to loss of privacy, and loan transactions can take days or even weeks to process. Borrowers might not be able to loan the funds they want, and worst of all, failure to repay your loans may result in bankruptcy or lawsuits in more severe cases. This gives rise to Thrupenny, an algorithmic DeFi platform for lending and borrowing. DeFi, which stands for Decentralized Finance, is an umbrella term for financial services that remove intermediaries and are accessible to anyone with an internet connection. In DeFi, cryptocurrencies are used instead of fiat money. Thrupenny enables users to deposit cryptocurrencies to earn interest in real time, as well as borrow cryptocurrencies at an interest rate. An important part of Thrupenny is that all loans are over-collateralized, meaning borrowers must deposit as collateral an amount more than they borrow. In case borrowers do not repay their loans, the collateral will be used to repay their debts. With Thrupenny, all loans are executed in a completely decentralized and seamless fashion, where loans are executed directly between many strangers in different parts of the world, while still enjoying full custody over their funds. This is made possible via the use of smart contracts, which are programs or protocols that digitally facilitate the execution of an agreement and are recorded in the blockchain. For example, John has one Ethereum, say, worth 1,000 USD, and wishes to earn interests with it. He can supply one Ethereum from his crypto wallet to the Thrupenny liquidity pool through the smart contract. On the other hand, Angel, who wishes to borrow Ethereum, can borrow the one Ethereum that is supplied by John to the liquidity pool by depositing a collateral in cryptocurrencies that is worth more than what she borrows. For instance, she can deposit 0.1 Bitcoin worth, say, $2,000 in collateral to borrow one Ethereum worth, say, $1,000. Upon repayment of the loan, Angel can redeem her collateral, in this case, her 0.1 Bitcoin, to her crypto wallet. Angel pays an interest fee that is paid to John for supplying his Ethereum. John earns the majority of the interest fees, and the rest is paid to the Thrupenny lending protocol as transaction fees. Through the use of liquidity pools, at any time, lenders can choose to redeem their deposited assets, and borrowers can pay back part or all of their loan. So why the need to borrow in the first place when you have to put up more collateral than you borrow? Borrowing cryptocurrencies allows users to unlock the liquidity of their existing crypto assets. In most cases, stable coins such as USDT or USDC, which are pegged almost one-to-one to the price of US dollars, are borrowed. Borrowing stable coins allows users to cover unforeseen expenses or leverage exposure on another crypto asset for speculation purposes. For example, John has one Ethereum and foresees the price of Ethereum will rise in the future. He does not wish to sell his Ethereum, but is in need of funds. Hence, he can supply his one Ethereum worth, say, 1,000 USD to the lending protocol and use his supplied Ethereum as collateral to borrow, say, 800 USDT. He can use the 800 USDT to pay off his expenses while keeping the upside potential of his Ethereum. Once he has sufficient funds to repay the 800 USDT, he can redeem his one Ethereum, which is held up in the smart contract. Another example would be John predicts the price of Ethereum would rise in the future. He could supply his one Ethereum worth, say, 1,000 USD and earn interests on his Ethereum. Using his supplied Ethereum as collateral, he could then borrow 800 USDT and buy another 0.8 Ethereum. Assuming the price of Ethereum increases from 1,000 USD to 3,000 USD, had John kept his 1 Ethereum in his wallet, he would have only 3,000 USD worth of Ethereum. If John had used his Ethereum to borrow USDT to buy another 0.8 Ethereum, he would have 1.8 Ethereum worth 1.8 ETH times 3,000 USD equals 5,400 USD. By repaying his loan of 800 USDT plus some interests, he would have a total of approximately 5,400 USD minus 800 USD equals 4,600 USD. In this instance, John would be better off by another 1,600 USD if he had borrowed funds. It is interesting to note that John could have used his 0.8 Ethereum as collateral to borrow more USDT to buy more Ethereum, thus leveraging his position even more. With the use of smart contracts in DeFi lending and borrowing, trust issues are removed because of the transparency smart contracts offer. Smart contracts are self-executing codes that once uploaded onto the blockchain, the contract cannot be tampered with, and nobody, including the programmer who wrote the contract, banks, or third-party intermediaries, can modify or amend it. The code is transparent on the blockchain for anyone to audit, and all transaction activity is also public for anyone to view. This is also why DeFi lending and borrowing is available to everyone with no need for sharing your personal information or trusting someone else to store your money. The markets are always open and transactions just take seconds to execute. Sounds good. However, two important aspects of DeFi lending and borrowing are collateral ratio and liquidation threshold. To start off with collateral ratio, the higher the quality of collateral, the higher the amount can be borrowed. Cryptocurrencies, which are less volatile, have higher collateral ratio and vice versa. For example, if ETH has an 80% collateral ratio and 10 ETH is put down as collateral, the borrower can borrow an amount in crypto worth up to 8 ETH. Next up is liquidation threshold. The liquidation threshold protects the lender by ensuring the value of their collateral is always higher than the amount they borrow. Borrowers have the responsibility of making sure the value of their collateral never drops below their liquidation threshold. Otherwise, they risk being liquidated. For example, John supplies 1 Ethereum, say worth 1,000 USD, and borrows 500 USDT. If the collateral has a liquidation threshold of 80%, it means the loan will be liquidated when the debt value is worth 80% of the collateral value. Hence, the lowest price that Ethereum can drop to for the loan to be liquidated is 500 USD divided by 80% equals 625 USD. When a loan is liquidated, a portion of the collateral is automatically sold to repay the debt, plus any penalties and fees, and any remaining collateral returned to the borrower. To avoid liquidation, John can raise his collateral value by depositing more collateral assets or repaying part of his loan. Typically, users will borrow less than their limit and leave a healthy buffer as the prices of cryptocurrencies can fluctuate and can cause borrowers to be suddenly caught out and be liquidated. So, that's all for DeFi lending and borrowing. Hope you enjoyed and thank you for watching.